This is Chris Marabella. It's July 26, 2023. It's almost 11:30 Pacific time, and we're about to listen in on Jerome Powell's testimony, Federal Reserve. They're expected to raise the federal funds rate by 25 basis points, try to slow the economy down, get inflation down. We'll see what happens with the 10-year Treasury once he starts speaking. So right now we're just kind of on hold here, waiting for him to start his testimony. So 10-year Treasury right now, right around 386. Federal funds rate, 5.25. They're supposed to raise by 25 basis points. We're just waiting on Jerome Powell start his testimony. We'll see how this will affect net lease market. Hopefully 10-year Treasury will rally on this news with more of a dovish expectation, although they're supposed to have another meeting in September, Federal Reserve, and possibly they may raise again. That's the expectation. All right, let's listen in to Jerome Powell now on his testimony.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
Keep that.
We understand the hardship that high inflation is causing.
Again, their mandate 2% inflation is what they're looking for.
Goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a quarter percentage point. And we
so they did raise
to reduce our securities holdings.
All right, so they did raise a quarter of a point. I would imagine the federal funds rate will go up on that news.
The effects of our tightening have yet to be felt.
We'll see what's happening with the 10-year Treasury shortly.
A data-dependent approach in determining the extent of additional policy firming that may be appropriate.
So they may do additional tightening down the road.
Reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains
the housing market's going up,
largely reflecting higher mortgage rates.
There's not much supply of housing, right?
Output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%.
All right, so there you go. Federal Reserve raised the federal funds rate, still slightly hawkish. We'll see in September what happens. 10-year Treasury moving around on that news. Give me a call if you need net lease financing assistance. 760-803-6464. Right now we're closing a Walgreens, a Longhorn Steakhouse, 7-Eleven deal. We're also looking at a Dollar General. If you're going to be out at ICSC in San Diego in October, jump on my website at the top. You can set up an appointment. Just go to www.marabellafinance.com, and I look forward to hearing from you. Thanks again.